You shouldn't even think about it until it's 50 to 1, in my opinion. It's coming out of the ground at 7 to 1. It's averaged about 45 to 1 for the last 100 years, price wise. And that was with a 16 to 1 geologic ratio. Now it's 7 to 1. It's disappearing. And the demand for it is out of control, with the U.S. government just classifying it a critical mineral.
When you do some research, you find that at local coin shops, there's a lot of people that are selling. And when that is done, and it will be done sometime soon, first of all, they're going to regret it. But second of all, without the people selling, it will explode. And just wait until gold also gets into all-time highs again. Once gold and silver are both in all-time highs, I think silver is going to turn into a rocket ship. He's got a target of $85 in a matter of 3 to 4 weeks. It could even be higher than that. I don't know.
The world's most informed investors are quietly making a move, and it has nothing to do with tech stocks, AI, or the S&P 500. According to precious metals experts Andy Schectman and Mike Maloney, silver is now so deeply undervalued, so structurally scarce, and so aggressively accumulated by insiders that we may be just weeks away from a price event unlike anything in modern market history. Today, we break down why the gold-silver ratio is screaming distortion, why industrial demand is exploding, why insiders are dumping stocks while buying billions in physical metal, and why silver's next move might not just be big, it might be violent. Let's get into it.
The fact that gold is up 70% and the S&P is up 16% amidst the greatest tech boom in history with the AI, and the insiders are selling $2 billion a week since June. It's not just Buffett. You got Bezos sold $7 billion in Amazon. You got insiders and board members of NVIDIA dumping a couple billion in stocks. You got Zuckerberg dumping, Jamie Dimon dumping, and the institutionals dumping, as the public is all in on stocks. The largest allocation to stocks they've ever had, 45% or so of the market is by retail investors. The largest exposure to options, which is speculation, and the largest exposure to margin debt, which is leverage, at all time, $1.5 trillion in margin debt, as the insiders are selling. And who the hell is buying billions and billions and billions and billions worth of gold and silver since November? Every month, we're net importers of gold for the first time in my career, and other than brief episodes, maybe ever. So who's buying all this gold? People at that level don't do things just for the hell of it. They know what's coming. At the same time, they're quietly exiting the equity markets as the public's all in. So I would say, whether or not Warren owns it, I think it is being accumulated by the most well-funded and well-informed traders in the world. And you can see that not only by the bleeding down of metals out of the LBMA, the massive deliveries way out of the ordinary every single month here on COMEX. Again, just the first 2 days of the COMEX contract, the December delivery, and I didn't see yesterday, which had been the third day. Day one, December silver contracts, 7,330 contracts stood for delivery. That's 36.65 million ounces, worth more than $2 billion. Not a record. April saw 11,692. And as mentioned further up in the daily delivery report, we're only into day 2 of the December deliveries, and there's already been 2.397 million ounces of gold delivered, plus a knee-wobbling 41.525 million ounces of silver issued and stopped. Those are in 2 days. You're talking billions of dollars worth of gold and silver every single month. Who the hell is doing it? That's the insiders, who are the most well-informed, the same ones that are leaving the equity market. You wonder if Warren is in there? Probably is, through some sort of a fund or whatnot. And when you buy stuff on the CME, there's no disclosure.
And it's in the 70s right now, I believe. And, it was I made some large purchases during COVID when it was up. I didn't nail 120 to 1, but I did get some that were way over 100, like 110. However, at 70, silver is still an extreme bargain at 70. It went to 30 in 2011. It went to 14 in 1980. And that day is coming again. But with the fundamentals underneath what's happening in silver, I would expect that we could go down way below 14 as far as the ratio. Silver's big move from the 4s into the 20s occurred while there was a silver deficit like there's been for the last 5 years. Then when it hit $48 in 2011, that spike, a whole bunch of people went out looking for silver. Takes a minimum of 5 years to get into production. And that's the reason you're seeing these small positive numbers. We had a deficit. The deficit went away, but there's this delay. And that delay is good because now it's saying that we're probably not going to get back into a positive situation with silver supplies until the 2030s. It takes a really high, the cure for high prices is high prices because it'll bring more to market, except to find a discovery, to turn it into a mine, and to get that ore above ground and refined into bars takes 5 to 10 years. There just isn't enough. There's not going to be enough for at least until the end of this decade. And that means super high prices. When you go to that market balance, less exchange traded products, that's 7 years of deficit.
Andy Schectman begins by highlighting the most alarming signal in the silver market. The natural mining ratio is 7-1, yet the market still prices silver at 70, 80-1 against gold. For the past century, the average price ratio was around 45-1, and that was based on an old geological ratio of 16-1. Now that the real-world ratio is 7-1, silver is even scarcer than most investors realize. At the same time, the U.S. government has officially classified silver as a critical mineral, confirming what analysts have warned for years. Supply is tight, demand is exploding, and inventories are thinning. Maloney points out that while industrial users and institutions accumulate aggressively, local coin shops still see retail investors selling, which temporarily masks the real shortage. But once that retail supply disappears, he warns, silver will explode, especially once gold breaks into new all-time highs. When both metals run together, silver historically behaves like a rocket ship, with upside targets as high as $85 in just a few weeks. Both experts then shift to the bigger macro picture. Despite the greatest tech boom in history, gold is up 70%, while the S&P has barely moved in comparison. Corporate insiders, Bezos, Zuckerberg, Nvidia executives, Jamie Dimon, and more, are dumping billions in stock. Retail investors, meanwhile, are more heavily allocated to equities, options, and margin debt than at any point in history. So who's been buying billions of dollars in physical gold and silver every single month? Schectman says the answer is clear. Elite, well-funded insiders who know what's coming. COMEX data shows massive deliveries, tens of millions of ounces of silver and millions of ounces of gold, standing for physical settlement. These are not small buyers. These are institutions draining global inventories. Silver's fundamental backdrop is even more extreme. The world has experienced 7 straight years of structural deficits, and new mines take 5 to 10 years to bring online. Even after price spikes in 2011, miners needed years to ramp up production. The industry now expects that we may not return to supply surplus until the 2030s. This means the market is heading toward a period where rising demand collides with immovable supply, creating super high prices, as Schectman puts it. Maloney then breaks down the gold-silver ratio, a powerful long-term valuation signal. When the ratio falls, silver outperforms gold, often in explosive waves. In 1980, the ratio crashed to 14-1. In 2011, it returned to roughly 30:1, its fair value zone. Today's levels, near 70, 80:1, signal extreme undervaluation. If gold merely doubles from here, and silver returns to ratios seen in past bull markets, the math suggests 5x to 10x gains for silver, at minimum. And that's before considering today's conditions: depleted inventories, record industrial demand, massive paper leverage, and unprecedented institutional accumulation. With insiders exiting stocks and flooding into precious metals, Maloney and Schectman believe the public is missing the biggest shift of the decade, one that may unfold much faster than anyone expects.
Yes, I had you invert it so that it show when silver is outperforming gold, this ratio is going up, not down. But you can also do the silver gold ratio, but then the scales on the side are in 0 point something or 0.0 something. And our brains just don't work as well that way. I wanted it in whole numbers. And so the gold silver ratio provides that. And this also, so whenever it's going up, silver is outperforming gold. But look at where it was in 2011, where it was in 1980, and then look at how undervalued it's been from 1990 until today. It is still an extreme bargain. It is dirt cheap. Now, look at what the average was, that red line going through all through the 70s. That red line, the 2011 peak, it only visited what was considered fair value against gold all through the 70s. That was like the natural balance of the gold silver ratio was about 30, and that's what it hit. It wasn't. There was an intraday, I think, where it hit 30, not 31.7. So this must be end of day, or maybe, it's not weekly. It's end of day. And 14 in 1980. So from where it is right now, it's saying that it should outperform gold easily. It'll outperform gold 2.3 times. And it could outperform gold by more than 5.2 times. And gold is still, I believe, a minimum of a double in dollars. And so you take this 5.2 times 2, 10.4 times, and that is the minimum. But the gold silver ratio could easily, when it hit 14, there was a huge strategic stockpile of silver that the U.S. had. They've sold it all off. The above ground stocks were far larger than they are today, far, far larger. Today, we are in a situation, and you didn't have, derivatives trading was very new. You didn't have hundreds of ounces of paper contracts for each ounce of real deliverable silver. The potential to blast past that 1980 peak of 14 exists. So if you're at 73 and it goes to 10, you got 7.3 times the return on silver that you would get at gold, and gold doubling that. The potential here for silver is just enormous.
If you found this breakdown helpful, hit the like button and share this video with someone who needs to understand what's really happening beneath the markets. Subscribe to our channel and turn on all notifications so you never miss a critical update on gold, silver, and global finance. Drop your thoughts in the comments. Are we on the edge of a historic silver breakout? Thanks for watching.